Well, thank you, everyone, for sticking with us. I know it's the end of the day, but hopefully we'll have I debated whether to use this, an electrifying final conversation. Just have to have a little bit of a pun to end the day. As we said in the introduction, this session is all about the power sector and the challenge of decarbonization in a time of rising demand. We've heard it across the day, the various factors from the push for electrification to rising demand from AI and data centers. So we're going to dig into those challenges, but also look at how there might be some opportunities here. And with that, I want to just start with Pedro and Maria to ask a sort of a very level-setting question. We know that demand is on the rise. How are you seeing it in your business, and how concerned should we be?
So I'll start, Dan, first, thank you, Justin. Great to be here with you. From an EEI perspective, we're the Industry Association for Investor-Owned Utilities, covering about 70% of the load in the country. If you had asked us 2 years ago, the projections for load growth were about 2.5%. The answer now is closer to 5%. In my home state of California, we've seen flat load for the last 15 years. We're seeing more in the 2% end. And that's being driven by 3 things nationally. In our home state, we see more of it coming from transportation electrification. I think at a broader national level, you're seeing data centers and AI, right? But you're also seeing the repatriation of manufacturing. The bipartisan infrastructure law and the CHIPS and Science Act both worked. And so you're seeing jobs coming back to the US. So how are we dealing with it? We are utilities, we are planners, right? And so there's a near, mid, and long term. I think long term, the trajectory continues to be pretty clear around supporting the clean energy transition and getting to as clean as we can, as fast as we can, but reliably and affordably. In the near term, though, the answer is really very regional, right? And I think in some regions, I'll take California as an example, we had a real pinch point back in 2020 with some really tough heat waves. Immediately after that, the state did a bunch of things, including adding gigawatts of storage, which made a big difference when we had another massive heat wave in 2022. I think in other regions of the country, you're going to see not only development of new resources, whatever can be developed quickly, but you also see optimization of existing resources. That's where technologies like grid-enhancing technologies can be a good part of the equation. But I suspect you're also going to see units that were slated to retire that may not retire quite as quickly as was originally planned, just to help balance it all out. And then, of course, working with customers to get good demand response as part of the picture. Right.
So just for a little bit of perspective, we're a vertically integrated utility. So we have 16, 17 generating facilities. We transmit, we distribute, and we sell power to about 2.5 million people and about 1 million different entities. The high-tech industry is our largest segment. We are home to 15% of the semiconductor manufacturing that takes place in this country, and one of the largest data center areas as well. If you think about the underwater cables that land in Virginia from the Atlantic, they land in Oregon from the Pacific. We've been growing for the last 5 or 6 years quite significantly. In fact, our load growth has grown probably about 10% just over the last 2.5 years. Our customer growth is also up 5%, and our invested asset base is up almost 30%. So the growth that we've seen, we've been forecasting for quite a while because we were part of the CHIPS and Science Act and a lot of the discussions with regards to Intel in particular. And $36 billion of their $100 billion investment will be right in our service territory. So this is going to be an enormous challenge. One of the things that is really exciting about it is that the customers that are growing the fastest are also aligned with the values of our customers. We have the #1 renewable energy program in the country for more than a decade, according to NREL. And we sort of reflect the ethos of the Pacific Northwest. So whether it is Intel with 100% clean energy goals by 2030, or any of the hyperscalers or others, being able to transform to a clean energy future with companies and entities that reflect our overall customer basis values makes the transition that much faster and that much easier. Although I would say that short term, medium term, and long term, with those planners that Pedro and I both work with, easy is not how they would define things. So this is clearly a challenge of of most people's careers the period of time we're going through.
Well, thank you. Those lay the ground very well. We'll pull on some of those threads later. But Sumant, I want to come to you. Pedro made the point that demand is rising much faster than projected here in the U.S. In India, of course, it's no surprise that the demand is rising as the economy grows very rapidly. Just could you talk a little bit about the role of renewables in this rising demand picture? And then just how do you think about decarbonization in the Indian context?
Yeah, sure. Thank you, Justin. So look, in India, what we're seeing is power demand grew by about 8% last year. And it's forecast to grow as per the IEA by at least 6 to 7% for the next many years to come. And given per capita power consumption in India is quite low, there's no reason for it not to keep growing for the next several decades at these rates. So what that means is that in a very large power system, if you have that kind of growth, then you need a lot of additional capacity to come in to service this demand growth. Now, in India, the government has taken the view that for commercial reasons and obviously for climate change reasons, that the first port of call for meeting this capacity addition should come from renewables. And so it's a great sign that we've sort of chosen to do that. And the target is that the current installed capacity of renewables in the country is about 170, 180 gigawatts, to increase that to 500 gigawatts by 2030. So kind of a 3x increase in the next 6 years. And to put that in context, the entire power system in India today, from renewables and non-renewables, is about 425 gigawatts. So the idea is to add almost that same amount of capacity, only via renewables, only in the next 6 years. So that's terrific, obviously. It's a huge ask. It's a huge task. It's great for companies like ours because it means we have a lot to do. The issue, however, is that this 7 to 8% demand growth is not going to be met by even this 500 gigawatts of renewable capacity addition. So we actually need even more capacity coming on stream than that. And the problem is that even pushing it out to 50, 60 gigawatts of new renewables every year is like a 2x or a 3x jump from where we are right now. So I don't think we can do any more than that in a short time period because there are physical limitations to how rapidly we can go. What that means is that we'll need more capacity to come in, unfortunately, from things like coal, because that's the only other source of capacity addition that we have. India doesn't have good natural gas resourcing, and so that means that we have to add more capacity through coal. So I would expect that we'll probably have about 400,000 megawatts of renewables getting added in the next several years, but then also maybe 50 to 70 gigawatts of additional coal-based capacities as well. And I think that's how we'll get to the meeting the demand growth numbers that we require. Now, this will obviously mean that there'll be more demand for coal as well as we go forward, more mining of coal and so on. But my sense is that just given how much we can start ramping up renewables over a period of time, maybe by 2030, 2035, we'll start seeing peak coal in India around that time. And that's when we'll start seeing renewables grow faster. The challenge, however, for us is that some of these numbers, I don't know how much they factor in the new data centers and the AI requirements, how much they factor in a fairly rapid shift to electric vehicles that is now beginning to happen in India, and also the fact that at some point you'll start needing green hydrogen coming in as well. And that's also, as we all know, based on renewable energy. And so all of that is going to be additive to this demand that I just talked about, which is really only based on the power sector. A lot of this is going to be incremental demand growth as well. And so it's going to be a little bit challenging to see how we meet all of this, without going any more towards the conventional sources of capacity.
Well, I'm tempted to follow up and ask you how to do it, but we'll get to that later. It's a very good cliffhanger there. Scott, Vernova has a portfolio of technologies. These are your customers. So I guess I'm curious just to get your sense of how you're seeing customers respond to this period of rising demand. What is the demand from customers? What do you see?
Well, I think our customers have incredibly difficult jobs right now because the reality is the load and demand growth that they need to manage is significant at the exact same time that they already have very discrete sustainability objectives that they need to meet simultaneously. And that's leading to very active discussions on really what the art of the possible is with capacity across a number of different technologies right now. The reality is there's going to be a lot more gas capacity additions added this decade in many parts of the world. We need to add an incredible amount of wind this decade, and a decade of action using the technology that exists today, and we need to do that while we're modernizing and expanding the grid, in which in all three of those cases, there's going to be real capacity bottlenecks that we need to address. But there's also going to be, in many cases, real sustainability challenges if we don't simultaneously continue to advance real breakthrough technologies. So the conversations with the customers really center on how do we multitask across both of those things, fulfilling the demand this decade while also continuing to build a chart towards our medium and long-term targets, including the sustainability targets that does still lead to some level of creation and innovation that doesn't exist in totality. So this is a complicated challenge, but an incredible opportunity to serve customers that have incredibly hard roles today.
Can I just, to pick up there and push you a little further, I mean, what does the order pipeline look like when you think about the different technologies? I mean, to the extent that you can share.
Sure. I mean, the sentiment with things like gas and nuclear, as an example, have changed drastically in the last 2 years. So that pipeline of activity is accelerating more quickly to orders today than even in some cases wind for us at the moment, where there's maybe a little bit more interest rate sensitivity and a little bit more project development evolution needed for an incredibly healthy pipeline. But you also need to get through the interconnect queue. You've also got to get the investments in the grid that aren't just dependent on that renewable power generation, but a system that could move faster than it is today. And there's some log jams there that are slowing down the development than what it could be, but that will solve itself. It's going to have to solve itself, because if it doesn't, the world's not going to get to its objectives.
So you mentioned interest rates, and of course that's been a theme throughout the day. Sumant, I'd come to you first, and I'd love to hear others just on the role of this high interest rate environment in India and what challenges that's posed for you in financing projects.
Well, you know, Justin, the reality is that for us, interest rates haven't gone up as much as they have in the Western world. Indian interest rates were always somewhat higher than what they are here, and they've gone up by maybe 25 or 50 basis points. And so it's not really impacted us that significantly. The second thing is there's a lot of liquidity in the domestic market in India. And so we've not had to go outside of India and sort of deal with the higher interest rates. We've been able to borrow within the country. The issue for us as a company, however, is that we're listed actually here on the NASDAQ. And that's turned out to, unfortunately, not be the best outcome for us, simply because global clean tech stocks are trading at multi-year lows, given what's happening on the interest rate side. And therefore, we just sort of got caught up in all of that. And so raising capital, therefore, has become a lot harder, not just for us, but for all clean tech companies. Because if you're trading at levels which are so low, then it's not very easy to raise a lot of capital. And to me, this is one of the most sort of underappreciated issues of dealing with climate change, that the interest rate environment is just not supportive of raising the huge trillions of dollars of capital that we need to raise at this point. And the funny thing is that despite all the growth that is there in the market, that is not being reflected by investors in the valuation of companies. And that's a little bit unfortunate, but it is what it is.
I'd also say California already has very high energy prices, but the impact of interest rates on other states' utility prices is very significant. We're huge capital deployers as an industry. And as a result of the high interest rates, customers are seeing bill increases that they haven't seen in decades. And there's some backlash that you can see across multiple states, including our own. So not only is it a problem in terms of deploying renewable assets and the cost, but it's going all the way through to the consumer, and the consumer is associating that with clean energy in this transformation. Whether that is the case, it could be any kind of capital, but it is absolutely the connection that many consumers are making.
Maybe if I could piggyback on that, I think that's right, Maria. I would add, though, that when you think about the investments required, right, fortunately, the industry does have continued access to capital. It's not an access issue, it is a cost issue. It's a cost to the consumer issue, because all those costs generally get passed through the bill. But a really important insight that I don't think is getting enough play yet is that as we look at the analysis, and we've done all this analysis around what it'll take to get the California economy to full net zero by 2045, one of the punchlines that comes out from the analysis is that, yes, we're going to have to make some really significant investments across the state in renewables and storage and the grid to facilitate a lot of electrification and other tools. But because this is a transition, right, and you have usage that's going today into gasoline and natural gas, a lot of which will transition to electric over those couple of decades. And because electric technologies are more efficient than their fossil fuel counterparts, we see our average customer actually spending 40% less on their total energy bill in real terms by 2045. That's huge. By the way, from a share of wallet perspective, it means that the share of wallet, the percentage of disposable income that's going across all forms of energy goes from 7% today to 3% in 2045. So that's an important counterpart to the story because, yes, you started with interest rate sensitivity, ultimately it's a cost sensitivity, but it's important that we be educating and grounding our customers and our policymakers in the fact that this transition may be driven by climate, but it has a big economic co-benefit in the end.
I think it's such an interesting point to take those two comments together because you're talking about customers seeing the higher electricity prices, and you use the word backlash, but then noting that actually it's reducing their energy costs. But how do you explain that? That's a really tricky challenge. I mean, maybe it's worth asking. How do you explain that to consumers, to customers?
We've been putting out these white papers. We put out consumer pieces. We educate. We engage at a grassroots level, and we have a lot more work to do.
Yeah. Okay, let's shift gears a little bit to talk about this hot topic of AI, data center computing, demand from computing. And I know, Maria, you already mentioned this. Oregon is a key state for this demand growth. Maybe you could just talk us through some of the specific things that can be done to reduce or to address demand from that area.
So let me just also piggyback on what Pedro was saying with regards to 2045. For those customers today, the energy growth is a huge reducer in the per kilowatt charge that most customers are seeing because we're spreading those fixed costs that we have over dramatically higher sales. And that's a big deal. And so I think as we look at this transformation of technology and AI and reshoring, more customers coming into the systems, and I would add electric vehicles into that as well, because that really is spreading out the usage to good times of the day and managed loads. So there's really three categories. The first one is energy efficiency. And to date, the tech industry has really not focused as much as they could on driving down energy efficiency and how we're processing large language models, how we're doing inference, and how we're computing overall. And I think you'll see as the technologists really focus on that area, that there will be dramatic reductions in increases in energy efficiency in that area and reductions in how much energy is being used. At the same time, we're going to be computing more and more. So that growth that we need to see managed is the interconnection between customers and their utilities. So we're really operating between the different customers almost as like one seamless unit. And we have a number of programs with our customers where we will shift their energy usage. They will call an energy event and get paid for it. We will use their backup generation. There's some really good white papers also written on this topic around how we can use battery storage to create a much stronger and resilient grid. Today, we're building the second largest installations of battery storage outside of California. It's really important we have these come on the system. But if you think of every data center which sells a 24/7 product, they have backup associated with that. And most of them do not run at full capacity. They run generally about 80%. So there's a lot of opportunity in terms of how we think about working with these customers. And they're very much coming to the table to figure out how they use energy and get their projects built as quickly as possible. And then I think the third one is the one that was referred to. It's going to be new energy sources. It's going to be small nuclear reactors. It's going to be more energy storage. It's going to be more renewables. And again, transforming into growth is a lot easier to do than the contrary. There's a lot more people looking at technologies that we really haven't spent much time on for probably 4 decades in this country. So I think it's a really exciting time, and it's a time of opportunity and a time of change.
If I just really quickly, you covered it well, the demand-side management piece of that how the data centers operate, the algorithms behind it is key. But also, I think it's fascinating that a few weeks ago when Jensen Huang unveiled NVIDIA's newest chipset, a lot of the headline wasn't about the compute power, it was about the power efficiency and the fact that it uses 25% less energy. And so I'm optimistic about seeing the chip manufacturers continue to work on more efficient chipsets.
Okay, I want to go back to Scott and Sumant in just 1 second, but I just want to home in on this one point here, which is, how much can be addressed with some of this demand-side technology? Because I do think there's a sort of knee-jerk sort of narrative that, okay, more demand means, from the utility perspective, you want to build more resources, which makes sense in a sense, but how much can actually be addressed with demand? And do you see uptake from utilities to pursue that?
So today, I think most of our peers have pretty robust demand-side management programs, right? And that can be either, as you're approaching a peak, finding ways to curtail usage. I would also include energy efficiency in that, which has been a real big driver of energy use reduction in the country and will continue to be that. So that's part of it. I would also add, maybe broaden your question a little bit and throw distributed resources into it, right? When we do our analysis in terms of where California is headed and how it gets to net zero, we see distributed being a big part of the equation. Today, I think something like 11% or so of rooftops in Southern California, Edison's territory, have rooftop solar on them. In our analysis, we assume that goes up to 50% by 2045. We see a lot more local, end-user level batteries as well. But again, the load increases that we see are so large that you really need it all. So there's a big component that gets addressed through distributed. There's a component that gets addressed through the demand side. These are critical, but you still need the resource additions because we're looking at least an 80% increase in total load use, total load in California. And by the way, that analysis, the vintage of that is about early last fall. I don't think our modelers appropriately captured yet the increases coming from AI.
Great. Okay, so Scott, I want to come to you. Maria mentioned small modular reactors. You also alluded to new technologies coming down the pike. What are you most excited about? What do you see potential for, either with SMRs, but more broadly?
We'll commission our first small modular reactor, 300 megawatt block of power with Ontario Power Generation in 2029. It'll start to become a relevant part of the capacity additions into the early 2030s, adding gigawatts a year of new nuclear. So it's definitely going to be part of the equation in the next decade. Lorenzo referenced direct air capture earlier, and many forms of carbon capture, whether it be direct air capture or point source carbon capture. As you look ahead into the next decade, at our research center today in Niskayuna, New York, we've got a direct air capture facility that's pulling carbon out of the air 24 hours a day, 7 days a week. That's a start. We've got a long way to go to industrialize the product at scale, and that's often going to take until the next decade off also. And while we work on those types of technologies, we've got to really take advantage of this decade of action to leverage all the technology that exists today to continue to electrify and decarbonize the world. And there's a lot we can do. And there's a lot we can do for some of the challenges with the load growth that our customers are serving, whether that being upgrading gas plants and getting more output and efficiency, whether it be repowering wind turbines, whether it be addressing the 5 or 6% efficiency losses on the grid. There's stuff we can do with technology that exists that does drive real savings in the efficiency of the system. And frankly, our fastest growing business today is our grid software business for exactly this. The reality is the system our customers are managing is becoming so complex with the variable power sources, but also the bidirectional flow of the electrons. We need to continue to upgrade the brains of the grid that make this whole thing work, and that's one of the things we're most excited about inside Vernova.
So let me give an example of what a customer would see with that really cool technology. So we have an integrated operations center, runs 24/7, and when there are peak periods of scarcity, whether it's too hot, too cold, the wind's not blowing, customers can opt into energy events. And they can just look on their cell phone, they can opt in, we can aggregate that energy, and we'll take down our peak demand quite significantly. These tools and technologies that are integrated throughout our distribution system, all the way back to our own generation, as well as customer-sided generation, is really quite remarkable today. And we think by 2030, we'll have 25% of our capacity will come from our customers and the distribution side of our system. So the technologies are not just like new nuclear, but they're really, generational changes that we're seeing in terms of how the entire grid is operating.
And that's why I'm more optimistic than not. Yes, there's this demand dynamic. We've got to continue to decarbonize the system. But we also still have, in some ways, a legacy system of power generation and then transmission and then distribution and a nascent distributed energy system that if we bring it all together and start to have one integrated system from the power generation source to the home and actually connect all those dots, there's an incredible amount of opportunity that we can drive in the system while acknowledging we are going to have to add more capacity while decarbonizing it. But there's no reason we can't do that.
Sumant, I'm going to come back to you on new technologies, particularly on green hydrogen, which I know has been a focus of yours. What have the barriers been? What are the opportunities? How are you seeing that market play out?
Yeah, a lot more slowly than we thought earlier, unfortunately. I think the reason is that, simply put, green hydrogen is just more expensive than the alternative gray or even blue for that matter. And so there's no real incentive for any user of hydrogen to just through a motor decide to shift. And so unless there's a mandate or unless there's a massive subsidy, I don't think that the shift is going to happen fast enough. And that's why we're seeing that there are every jurisdiction or region has announced massive plans or targets, but it's things that are actually on the ground moving fairly slowly. So for example, we are talking to the German entity called Hinco to supply to them green hydrogen under one of their subsidy programs, but we've been talking to them for the last 1 year, and the final bids haven't even gone in. And this is just the first pilot program. And these projects will get supplied only in 27, 28. And then, so then there'll be the next round of subsidies. So all of that is just moving very slowly. Plus, the user industries haven't yet figured out how much hydrogen they can use and how they can use it. So for example, in the Far East, you would know that people like JERA, for example, are trying to change the, or blend more and more hydrogen into their thermal power systems. And so they're sort of concluding those studies. But again, that is taking time. So I think, to me, it's very clear that green hydrogen will become very big, but I suspect it will happen mostly after 2030. Until then, we'll probably have, more small-scale projects happening, more sort of test cases type situations going on. And I think it's only after that that mandates will become really much stronger. And I think, look at it this way, renewable energy today is, the alternative. The alternative for energy is, let's say, gas or coal. In India's case, as you know, it's coal. Coal prices in India are 5.5 to 6 rupees, whereas the cost of renewables is 2.5 to 3 rupees. So there is a lot of opportunity for us to add more and more renewables and eventually start displacing coal from a very strong commercial reason. In hydrogen, that is not the case yet. And unless that happens, we won't see the same kind of uptake taking place, because we know that gray hydrogen costs maybe $1.5 to $2, and green hydrogen costs maybe $3.5 to $4. So there's no real reason for anybody to make that move.
I'm just going to ask one more question and switch to audience questions to Sumant, to you. I mean, we've heard a lot today about conversations around international financial institution reform, which of course this is very timely, as well as some of the conversations around the implications of the Inflation Reduction Act across the globe. I'm curious from your vantage point, what is the most useful thing you would like to see, whether that's multilateral agreements, whether that's trade partnerships? What would be the fastest or the most helpful to accelerate the transition in India from a global context?
Well, to talk about this more broadly, not just from an India context, I think what's happening is that, first of all, we have a massive supply chain dependency on one country. And that's not healthy at all, and we all know that. But the problem is, we've known that for a while, but I don't see countries doing enough to come up with really firm plans to have that diversification going properly or effectively, right? So certain countries are doing little pockets of things. For example, India has put in a hard barrier to importing solar modules from China, right? The US has come out with some form of trade barriers, non-tariff barriers, and then, obviously there's a massive subsidy through IRA. The European Union knows that it needs to diversify, but it's not really done anything tangible yet. So these countries, these regions aren't really coming together and saying, okay, let's sit down and discuss what kind of trade policy do we need for addressing the supply chain issues going forward. That's not happening. I don't see any conversations in any of the forums that I'm going to of countries coming together and having those kind of very fundamental trade policy discussions. So I think that's one fundamental issue that we are looking at. As far as financing is concerned, again, we've had the multilaterals who actually should be playing a very critical role. They've just been somewhat missing in action so far, right? There's been a lot of talk when you talk to multilaterals. They're all very supportive. But in terms of actually doing something, it's just not happened, right? And now, of course, we're trying to reform the World Bank and all of that stuff is going on. But I think all of it is just too slow and time is passing, right? I think what we need, again, radical, is we need to create a whole different Bretton Woods kind of institution focused entirely on climate financing and get all the countries of the world together, put in the capital, and set these institutions up from scratch, right? If you take existing systems which are relatively moribund and have all sorts of competing mandates and existing bureaucracies, it's going to be very hard to change them. And it's just going to take too long. So I think the time has come for the world to get together and just say, you know what, let's create something like this, which is entirely focused on, coming up with the kinds of products, financial products, that catalyze a lot more institutional capital from around the world into emerging markets and wherever else it needs to go. And again, a radical thought is that we tend to focus a lot on a lot of small emerging market countries. That's not really where the battle for climate change is going to be fought. It's going to be fought in the large emitters. And that's where we need to channelize the capital and the products and the equipment and make a real difference.
Love it. A call for a new Bretton Woods institution I think it would be great. So we have a question here from the audience about supply chain challenges for transformers and other grid hardware, and this is to Pedro or Maria. What can be done to alleviate the backlog for those supply chain challenges?
Yeah, so this is an area where we've had strong partnership with the federal government, and they really have been trying to help. First, acknowledge that the supply chain crunch has been real, right? And it really started during the pandemic, and it's continued. Give you an example, distribution transformers, a typical pull-top transformer that might have taken 12 weeks to be provisioned in the past is now many, many months, right? And so the industry has come together, our chief procurement officers, to the extent allowed under the law, been able to compare notes and a collective demand signal to manufacturers. You are seeing the federal government stepping in and helping with that messaging. We have a group that's called the Electricity Subsector Coordinating Council, which is a CEO-led group that is the main partnership between our industry and the federal government on issues of physical and cybersecurity. And the ESCC has had a working group, around this topic as well. But it's frankly taking some time, and we're seeing ebbs and flows here. A couple of years ago at Edison, we have smart meters. They're actually coming of age now. We simply could not get replacement smart meters because of the chip shortage. And so we got really smart at having our folks take meters out of the field and repair them and then put them back in the field. That has abated. We can get supply now again, partly because we diversified the supply there. It's not just transformers. It's also the less sophisticated equipment. We call it our B material. Things like connecting elbows and stuff that you wouldn't, it's not big SKUs, but it's a lot of them. So we're all living through this, and importantly, getting that demand signal to manufacturers. Then on the government side, their help in helping to build manufacturing supply in the U.S. or in near-shore friendly countries, because it's not just about supply availability, it's also about the security, and especially the cyber security of the supply that we can access.
Scott, do you want to come in?
Yeah, no, if I had a little perspective there, I'd just say when you think about the macro dynamic where we accept the demand for electricity is going to grow by 50% the next 20 years while we simultaneously decarbonize the electric power system, we're not going to solve this with hobbies. We need to really take this on from a supply chain perspective, building things that we can industrialize at scale. Yep. And this can be a little bit less about the next modest new product introduction that provides a little bit more technology, and really take a step back and say, are we hardening a supply chain for this world challenge that allows us to ramp up the industrial scale that's required in the world? And that may be some of the most exciting part of what needs to happen. Because in some ways within the energy transition, we've been guilty of having many small iterations on what sometimes I talk about as PowerPoint economics that we think save the world money or carbon efficiency, but that only comes to be if we can actually do it at scale. And from an OEM perspective on our end, that's really what we're focused on. So you think about wind, we're spending a lot more money of our engineering today in wind on robotics inspection technology to make sure the blade comes out of the factory right the first time versus developing the next blade. Because there's just such a scale challenge we have that we've got to approach the problem in maybe a different way.
I also think we've been using our infrastructure that was built decades ago. We have gotten every last bit out of that infrastructure. Sometimes we've replaced it and modernized it, and many times we've left it. And so there is, to a certain extent, some aging infrastructure debt that we all need to deal with. As this country moved our manufacturing offshore, we should expect when we move it back onshore, and it's much more energy intensive, particularly on the electricity side, that it's going to take some investment. It's going to take some investment at scale.
So we only have 1 minute left. I'm going to ask this question and then add my own, and hopefully we can answer it in a minute. But the question here is, can supply chains keep up with renewable build-out timelines, which I think connects with what we were just talking about. But I also just want to ask, when you think about this moment of rising demand, does this slow our decarbonization timeline, or in the long term, are you able to make things, or will things be able to level out? And I'd ask Pedro just to maybe close us out on this one.
I think the long term stays the same. Maybe there's a little bit of movement around that. The near term will have its bumps in the road. But markets end up responding, and especially with the help of government to get there, I'm optimistic that we can address this. It might have changed, as I said earlier, some retirement dates, might have changed some of the path. I'll also say it's not just what the energy sector is doing and what government is doing, but it's also what large corporations are doing. We have our other Edison international company is Trio, which is an advisory services company serving about a quarter of the Fortune 100. It's global scope. We're not seeing all these customers who have their net zero commitments signaling anything yet about changing those. But there's some recognition that the path there may be a little different than we thought.
Okay, great optimistic-ish note to close on. Thank you to the panel. Great discussion.